Good day everyone. Today, we will discuss the latest amendments to IFRS 3 or business combinations. But before we advance to the updates of IFRS 3, let me first give you a brief discussion of the standard. IFRS 3 establishes principles and requirements for how an acquirer in a business combination recognizes and measures in its financial statements the assets and liabilities acquired and any interest in the acquiry held by other parties. Under the standard is also the determination of recognition and measurement of goodwill or a gain from a bargain purchase, including information to disclose to enable users of the financial statements to evaluate the financial effects and nature of the business combination. The core principles in IFRS 3 are that an acquirer measures the cost of the acquisition at the fair value of the consideration paid. It allocates the measures to the acquired identifiable assets and liabilities on the basis of their fair values. It allocates the rest of the cost to goodwill and recognizes any excess of acquired assets and liabilities over the consideration paid, or a bargain purchase, in profit or loss immediately. The acquirer discloses information that enables users to evaluate the nature and financial effects of the acquisition. Let's now proceed to the updates. In our report, we will revisit two amendments. The first one is from 2018, which provides the changes and definition of a business. This update aims to give light to clarifications regarding the definition of a business, with the aim of helping entities to determine whether a transaction should be accounted for as an asset acquisition or as a business combination. The other update is reference to the conceptual framework issued by IASB last May 2020 as replacement to the 2018 conceptual framework. The motivation of the said amendment was initially to replace a reference to the framework for the preparation and presentation of financial statements issued in 1989, which is the 2018 conceptual framework. To further give you a fair and comprehensible discussion, here is our outline as we get across the whole report. So we're going to discuss the IFRS 3 amendments, clarifying what is the business. So for the first part, we're going to differentiate the old definition versus the new definition of a business. Then we're going to list down the 2018 amendments and also the effective date and the transition of the amendment. And we're going to give you some illustrative examples and the summary of the whole update.
Let's start the discussion about the IFRS 3 amendments by comparing the old definition of a business to its new definition. In the old definition, it defined business as an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return in the form of dividends, lower costs, or other economic benefits directly to investors or other owners, members, or participants. This definition is amended and it now says that a business is an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods or services to customers, generating investment income such as dividends or interest, or generating other income from ordinary activities. A while ago, it has been said that the amendments clarify the definition of a business with the objective of assisting entities to determine whether a transaction should be accounted for as a business combination or as an asset acquisition. Before we formally proceed with discussing the amendments, let us see first the difference between business combination and asset acquisition. In business combination, the assets acquired are generally recognized at fair value, while in asset acquisition, the acquired assets are recognized in accordance with the other applicable GAAP. In business combination, the transaction costs are expensed as incurred, while in asset acquisition, the transaction costs are typically capitalized. In business combination, the goodwill is recognized as an asset and the bargain purchase is recognized as a gain and net income in year of acquisition. While in asset acquisition, both are not recognized. Lastly, and business combination, the deferred taxes are recognized as assets and/or liabilities, while in asset acquisition, the deferred taxes are not recognized unless a specific circumstance applies. After we discuss the difference between business combination and asset acquisition and compare the new definition of a business to its old definition, let us now discuss the changes to IFRS 3 in detail. What changes have really been made to IFRS 3? First, it narrows the definition of outputs and a business. I have presented a while ago the old definition and new definition of a business. So, let's now proceed with comparing the old definition of outputs to its new definition. Before the amendments, output is defined as the result of inputs and processes applied to those inputs that provide or have the ability to provide a return in the form of dividends, lower cost, or other economic benefits directly to investors or other owners, members, or participants. But now in IFRS 3 current version, it defines output as the result of inputs and processes applied to those inputs that provide goods or services to customers, generate investment income such as dividends or interest, or generate other income from ordinary activities. In these two cases, we can notice that the definition of a business and outputs in IFRS 3 prior to the amendment focused on returns which can be in the form of dividend income, lower cost, or other economic benefits to investors and owners. But the changes narrow the definition by focusing on providing goods and services to customers, removing the emphasis from providing a return to shareholders, and removing the reference to lower cost or other economic benefits. Second, it amends guidance on inputs, processes, and outputs in paragraph B7 to align with the new definition. Inputs refer to economic resources that can contribute to the creation of outputs when processes are applied to it. Examples include tangible fixed assets, right-of-use assets, right-of-use intangible assets, and intellectual property. On the other hand, processes include a system, standard, protocol, convention, or rule that when applied on input, creates output or can contribute to the creation of outputs. Examples include strategic management processes, operational processes, and resource management processes. And lastly, outputs are a result of inputs and processes applied to those inputs that provide goods or services to customers, generate investment income such as dividends or interest, or generate other income from ordinary activities. Example includes revenue. To support the new definition of a business, the application guidance contained in IFRS 3 paragraph B7 has been amended so that inputs and processes no longer need to have the ability to create outputs. Instead, they merely need to have the ability to contribute to the creation of outputs. IFRS 3 also emphasized that the intellectual capacity of an organized workforce having the necessary skills and experience in following rules and conventions may provide the necessary processes applied to inputs to create outputs. And as what I have said earlier, the focus on inputs is now on returns from goods and services provided, investment income, and other income from ordinary activities.
Third, it clarifies that to be considered a business, an acquired set of activities and assets must include, as a minimum, an input and a substantive process that together significantly contribute to the ability to create outputs. The amendments acknowledge that despite most businesses having outputs are not necessary for an integrated set of assets and activities to qualify as a business. In order to meet the definition of a business, The acquired set of activities and assets must have inputs and substantive processes that can collectively significantly contribute to the creation of outputs. Based on the amendment, the acquired inputs and processes does not necessarily have to create the outputs, but to be considered a business, an input and a substantive process must come together and contribute to the creation of outputs. If it will be an input alone, then it's not considered a business. And if only a substantive process is present, then it will not be qualified to be a business as well. The amendments on the definition of a business also clarify that, first, outputs are not necessarily required for an integrated set of activities and assets to qualify as a business, and contribution to the creation of output of these activities and assets is enough. Second, a business need not necessarily include all inputs and processes used by the seller in operating the business. The business has the choice to choose which inputs and processes will be acquired through the transaction. And lastly, if an acquired set of activities and assets has outputs, continuation of revenue like a recurring revenue stream does not by itself indicate that both an input and a substantive process have been acquired. Fourth, it provides extensive guidance on what is meant by a substantive process. Extensive guidance has been added to IFRS 3 as part of these amendments to assist in determining whether an acquired process is substantive. The standard requires entities to assess whether the acquired process is substantive. The standard has a different analysis depending on whether the acquired set of activities and assets has outputs or not. An example of an acquired set of activities and assets that does not have outputs is a new entity that has not yet generated revenue. If the acquired set of activities and assets is generating revenue at the acquisition date, it is considered to have outputs. For activities and assets that do not have outputs at the acquisition date, the acquired process is substantive only if it is critical to being able to develop or convert an acquired input into outputs, and the inputs acquired include the following: an organized workforce that has the skills, knowledge, or experience to perform the process, and other inputs that the organized workforce could develop or convert into outputs. For example, intellectual property that could be used to develop a good or a service, other economic resources that could be developed to create outputs, or rights to obtain access to necessary materials or rights that enable the creation of future outputs. There would be no substantive process and therefore no business when an entity acquired a process with inputs but a workforce that is not sufficiently skilled, or a process and a skilled workforce but no other inputs to develop and convert into outputs. For activities and assets that have outputs at the acquisition date, the acquired process is substantive if, when applied to an acquired input or inputs, it is critical to being able to continue to produce outputs, and the acquired inputs include an organized workforce with the necessary skills, knowledge, or experience to perform the process, or it significantly contributes to being able to continue producing outputs, it is deemed to be unique or scarce, or it can be replaced without significant cost, effort, or delay in producing outputs.
Okay, for number 5, the additional of an optional concentration test as a shortcut way of concluding that certain types of acquisitions are not business combinations. Many participants in the post-implementation review of IFRS 3 noted that applying the definition of a business involved significant judgments and that IFRS 3 provided little or no guidance that identifies situations in which an acquired set of activities and assets is not a business. To address these concerns, in the 2018 amendments, the board added a concentration test that is designed to reduce cost and complexity by avoiding the need for a detailed assessment in some circumstances. The test is an optional test. It allows the acquirer to carry out a simple assessment to determine whether the acquired set of activities and assets is not a business. The entity can choose whether or not to apply the concentration test for each transaction it makes. If substantially all of the fair value of the gross assets acquired is concentrated in a single identifiable asset or group of similar identifiable assets, the concentration test is met, and the set of activities and assets is considered not to be a business. If the concentration test is met, no further assessment is needed. The board designed the concentration test with the aim of making it easy to understand, and in some straightforward cases that are easy to explain, simple to operate and less costly than applying the detailed assessment, otherwise required by other assessments. To target that aim, the concentration test focuses on a single identifiable asset or a single group of similar identifiable assets. The board did not expect entities to carry out detailed calculations to apply the test, because detailed calculations would have frustrated the purpose of the test, which is to permit a simplified assessment. In addition, the board wanted the test to have the same outcome in most circumstances as the detailed assessment, and wanted to minimize the risk that the outcome of applying the concentration test could deprive users of financial statements of useful information. Okay, for the transition, entities are required to apply the amendments to transactions for which the acquisition date is on or after the beginning of the first annual reporting period, beginning on or after January 1st, 2020. For the additional note, earlier application of these amendments is permitted. If an entity applies these amendments for an earlier period, it shall disclose that fact.
Example 1. Acquisition of a radio station. An entity sells its radio broadcasting assets to another entity. The acquired set of activities and assets sold comprise the broadcasting license, the broadcasting equipment, and a broadcasting studio. At the acquisition date, the fair value for each of the assets sold is considered similar. No processes needed to broadcast the radio shows are sold, and there are no employees or other assets, activities, or processes included. Entity S has stopped using the acquired set of activities and assets before the date they are sold to Entity R. Here is the analysis. Entity R decides to apply the optional concentration test and determines that the broadcasting equipment and the studio are not a single identifiable asset because the equipment is not attached to the studio and can be separated without being costly or causing a loss of use of fair value of other assets. Second, the license is an intangible asset and the broadcasting equipment and studio are both tangible assets belonging in different classes. As a result, the assets are not considered similar to each other. Lastly, there's a similar fair value for each of the single identifiable assets. Thus, the fair value of the gross assets acquired is not substantially all concentrated in a single identifiable asset or group of similar identifiable assets. Therefore, the concentration test is failed. Entity R therefore assesses whether the acquired set of activities and assets meets the minimum requirements to be considered a business. The acquired set of activities and assets does not have outputs because Entity S has stopped broadcasting. Thus, Entity R applies the relevant criteria in IFRS 3 to determine whether the process is substantive. As the set does not include an organized workforce, the relevant criteria have not been met. Therefore, Entity R concludes that the acquired set of activities and assets is not a business.
Marquee Corporation purchases from Beanie Corporation the worldwide rights to product SKZ, including all related intellectual property. In addition, Marquee Corporation also purchases all the existing customer contracts and customer relationships, inventories of finished goods, customer incentive programs, raw material supply contracts, specialized equipment specific to manufacturing product SKZ, and documented manufacturing processes and protocols to produce product SKZ. Marquee Corporation does not acquire any employees, other assets, other processes, or other activities. None of the identifiable assets purchased has a fair value that comprises substantially all of the fair value of the gross assets acquired. For the analysis, as the fair value of the gross assets acquired is not substantially all concentrated in a single identifiable asset or group of similar identifiable assets, the optional concentration test will not be met. As a result, Market Corporation assesses whether the acquired set of activities and assets meets the minimum requirements to be considered a business. Market Corporation considers whether the acquired process is substantive. The acquired set of activities and assets as outputs, and so Market Corporation considers the relevant criteria in IFRS 3. The acquired set of activities and assets does not include an organized workforce. However, Market Corporation concludes that the manufacturing processes acquired significantly contribute to the ability to continue producing products and are unique to product SKZ. Therefore, Market Corporation concludes that the acquired processes are substantive. In addition, Market Corporation determines the substantive processes and inputs together significantly contribute to the ability to create outputs, and as a result, Market Corporation concludes that the acquired set of activities and assets is a business.
Okay, for illustrative example number 3, MD Company purchases Solar Cell. Solar Cell carries out research and development activities on several solar projects that it is involved in and are currently in progress. It is scientists who possess the skills and knowledge and experience needed to perform these activities. It also has tangible assets which include lab equipment and a factory and a laboratory to perform such activities. Currently, the project is not ready to be marketed and no sales have been made. All of the assets acquired are deemed to individually have a similar fair value. So for the analysis, MD Company elects to apply the concentration test, which was discussed a while ago, and concludes that the fair value of the gross assets acquired is not substantially all concentrated in a single identifiable asset or group of similar identifiable assets. Therefore, MD Company assesses whether the set meets the minimum requirements to be considered a business. MD Company determines that no processes have been documented for entity Solar Cell. However, the organized workforce that has been purchased has proprietary knowledge of the ongoing projects. Therefore, MD Company believes that the workforce provides intellectual capacity which provides the processes needed that can be used as inputs to create outputs. MD Company then determines whether the acquired processes are substantive. There are no outputs derived from the acquired set of activities and assets. So MD Company applies the relevant criteria in IFRS 3 and concludes that the processes are substantive because number 1, the processes purchased are essentially to be able to develop or convert the acquired inputs to outputs. And the acquired inputs include an organized workforce that has the necessary skills, knowledge, or experience to perform the necessary duties associated with the processes acquired, and the other inputs that the organized workforce could develop or convert into outputs. Those inputs include the research and development projects that are in progress. Finally, MD Company determines that the substantive processes and inputs it has acquired significantly contribute to the ability to create outputs. Therefore, MD Company includes that the acquired set of activities and assets is a business.
In summary, the amendments clarify the minimum attributes that the acquired set of activities and assets must have to be considered a business, narrow the definition of a business and the definition of outputs, and add an optional concentration test that allows a simplified assessment of whether an acquired set of activities and assets is not a business. And what is the commercial significance of these amendments? The amendments could impact all business combinations and purchases where it is unclear whether an asset or your business has been acquired. The impact could be significant if the outcome as to whether there is a business changes.
Now let's dive into the second amendment pertaining to the reference to the conceptual framework. In this part, we will answer the questions what, why, and when. First, what is the amendment about? Second, why did they have to amend it? And third, when will it be applied? The discussion of these amendments will be divided into three important parts: the background, changes, and the effective date.
In March 2018, the IASB issued the 2018 Conceptual Framework, and most references to the framework included in IFRS 3 were updated to the 2018 framework at that time. However, paragraph 11 of IFRS 3 Business Combinations, which continued to refer to the 1989 framework, was not updated, as this could have caused conflicts for entities applying IFRS 3. Potential conflicts occur as the definition of assets and liabilities in the 2018 framework differ from those in the 1989 framework, potentially leading to day 2 gains or losses post-acquisition for some balances recognized. In a May 2019 exposure draft, the IASB identified 3 possible amendments to IFRS 3 that would update IFRS 3 without significantly changing its requirements. And in May 2020, these amendments have been finalized.
Here are the following amendments in the reference to the conceptual framework. For the first one, the replacement to 2018 framework. Initially, the amendment was established to replace the framework for the preparation and presentation of financial statements issued in 1989 to the 2018 conceptual framework without significantly changing its requirements.
Okay, for number 2, recognition exemption for liabilities and contingent liabilities within the scope of IAS 37 or IFRIC 21. For the old recognition, to qualify for recognition as part of applying the acquisition method, the identifiable assets acquired and liabilities assumed must meet the definitions of assets and liabilities in the framework for the preparation and presentation of financial statements in the 2018 framework at the acquisition date. For the amended recognition, to avoid day 2 gain problem brought by the recognition principle in the 2018 conceptual framework, the IASB added a paragraph. The conceptual framework for financial reporting defines a liability as a present obligation of the entity to transfer an economic resource as a result of past events. For a provision or contingent liability that would be within the scope of IAS 37, the acquirer shall apply paragraphs 15 to 22 of IAS 37 to determine whether at the acquisition date a present obligation exists as a result of past events. For a levy that would be within the scope of IFRIC 21, the acquirer shall apply IFRIC 21 to determine whether the obligating event that gives rise to a liability to pay the levy has occurred by the acquisition date. The IASB's analysis led to it to conclude that the problem of day 2 gains or losses would be significant in practice only for liabilities that acquire accounts for after the acquisition date by applying IAS 37 provisions, contingent liabilities and contingent assets, or IFRIC 21 for levies. The IASB noted that adding this exemption to the recognition principle would not only avoid day 2 gains or losses, it would also avoid any changes to the assets and liabilities recognized in the business combination ahead of any future amendments to align IAS 37 and IFRIC 21 with the 2018 conceptual framework.
For the third amendment, an acquirer does not recognize contingent assets acquired in a business combination. The IASB added paragraph 23A to IFRS 3 to clarify the requirements for contingent assets. IAS 37 defines a contingent asset as a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. And according to the IFRS 3 current version, the acquirer shall not recognize a contingent asset at the acquisition date.
The amendments published are effective for annual periods beginning on or after January 1, 2022. Early application is permitted if an entity also applies all other updated references or those published together with the updated conceptual framework at the same time or earlier.
IAS 16 proceeds before intended use. Today, I will be discussing the latest amendments to IAS 16, Property, Plant, and Equipment. But first, before we proceed to the latest revision or amendment, let me discuss to you what is property, plant, and equipment. Property, plant, and equipment. This standard outlines the accounting treatment for most types of PPE. According to IAS 16, paragraph 6, PPE are tangible items that are held for use in the production of supplies of goods or services, for rental to others, and for administrative purposes, and are expected to be used for more than one period. For example is, you are a manufacturer of ice cream. So the machinery that you are using to manufacture the ice cream, that's your PPE, but the ice cream that you're making is your inventory. It also says here that PPE is expected to be used for more than one period, which it is qualifies as non-current asset. When it comes to recognition of this standard, according to paragraph 15 and 16, the item of property, plant, and equipment that qualifies for recognition of an asset shall be measured at cost. So what are the elements of those costs? First, it's its purchase price, including import duties and non-refundable purchase taxes, after deducting trade discounts and rebates. The second one is any cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. These are costs that would have been avoided if the asset had not been purchased or constructed. So basically, the best example of this directly attributable cost is freight charges that we paid to deliver the PPE and also the installation costs. The last one is the initial estimate of the cost of dismantling and removing the item and restoring the site on which is it located. So let's now proceed to the amendments or updates that we will be discussing. These amendments is from 2020 revision to IAS 16 regarding the proceeds from selling items produced while bringing an asset into the location and condition. So for the overview or background, before the 2020 amendments, paragraph 17 specified that directly attributable costs included the cost of testing whether an asset was functioning properly after deducting the net proceeds from selling items produced while bringing the asset into the location. The board developed the proposed amendments in response to a request to a committee asking whether the proceeds specified in paragraph 17 related only to items produced while testing. The second one is an entity was required to deduct from the cost of an item of property, plant, and equipment any such proceeds that exceeds the cost of testing. So what triggered this amendment? The first one is the issue mainly affects a few industries. The second one, according to board's research, different entities had applied the requirements in paragraph 17 differently. Some entities deducted only proceeds from selling items produced while testing. Others deducted the proceeds of all sales until an asset was in the location and condition, and for some entities, the proceeds deducted for the cost of an item, property, plant, and equipment could be important, could exceed the cost of testing. So after considering those findings, in May 2020, the International Accounting Standards Boards issued an amendment to IAS 16, Property, Plant, and Equipment, which aimed to clarify how companies of entities should account for the proceeds from sales. The board concluded that this amendment would provide relevant information to users of financial statements by requiring all the entities to recognize all sales as income, including revenue, when they occur, and on the other side, because some sales proceeds may be offset against the cost of property, plant, and equipment. Prior to the rules in IAS 16, it was difficult for a user to get a clear picture of an entity's overall revenue in the period. These constraints can make it difficult to determine the actual cost of some property, plant, and equipment. Deducting sales revenues before the assets are ready for use can affect the cost of the assets. This made comparing financial circumstances and performance of companies challenging for investors. By clarifying the accounting rules, the revisions promote transparency and uniformity. What specifically is the amendment? The board decided to amend IAS 16 Property, Plant, and Equipment to prohibit an entity from deducting from the cost of an item of PPE the proceeds from selling items produced before the asset is available for use. So prior to the amendment, the proceeds from selling the items produced while bringing the asset to the location and condition will be deducted from the cost of an item of PPE. This means that the prior treatment required that any cost incurred and revenue recognized up to the point that asset is ready for use be capitalized, or in the case of revenue, offset against the cost of an asset. Under the new amendment, the amendment to this IAS 16 prohibits a company deducting from the cost of an item of PPE available for its intended use. The example for this situation is during the necessary testing or commissioning period. Consequently, a firm or company would recognize such sale proceeds directly in the profit or loss. To start off with, the International Accounting Standards Board, or IASB, has amended IAS 16 Property, Plant, and Equipment, proceeds before intended use, regarding proceeds from selling items produced while bringing an asset into the location and condition necessary for it to be capable of operating in the manner intended by the management. So here is our framework or highlights as we go through the entire report to give you a more understandable conversation of our whole report. IAS 16 proceeds before intended use. So the first one is sales proceeds no longer be deducted from the cost of property, plant, and equipment before its intended use. The second one is testing the functioning of property, plant, and equipment means assessing its technical and physical performance. The third one is additional disclosure requirements for sales proceeds and related production costs. And the last one is transition requirements. Sale proceeds no longer deducted from the cost of PPE before its intended use. For better understanding in the process of making property, plant, and equipment available for its intended use, a firm may manufacture and sell products such as mineral extracted during the construction of an underground mine or oil, and gas taken from testing wells before starting productions. The International Accounting Standards Board has modified IAS 16 Property, Plant, and Equipment to offer advice or provide guidance on the accounting for such sale revenue or proceeds and corresponding production cost in order to address variability in practice. Under the amendments effective this year 2022, the proceeds from the sale of commodities such as extracted minerals and test products before the accompanying property, plant, and equipment is ready for its intended use are no longer subtracted or deducted from the cost of PPE. Instead, the proceeds as well as the expenditures or creating items are included in profit or loss. Companies will therefore need to clearly distinguish between the cost of producing and selling items before the PPE is available for its intended use, and the cost of making the PPE available for its intended use. This cost distribution may necessitate a lot of estimation and judgment. In order to allocate expenses to the things produced and sold, businesses must first identify what is normal capacity. Companies may not be able to easily estimate the asset's usual capacity or a relevant production measure in order to cost the output produced since the asset is currently being built. For better understanding, let me give you an illustration. ABC Company acquired factory equipment overseas on cash basis for $100,000. Additional costs incurred include the following: commissions paid to brokers on the purchase 5,000, import duties 25,000, non-refundable purchase taxes 10,000, freight cost of transferring the equipment to ABC Company's premises 1,000, cost of assembling and installing the equipment 2,000, cost of testing the equipment 1,500, administration and other general overhead costs 4,200, and advertisement and promotion costs of the new product to be produced by the equipment 3,800. The samples generated from testing the equipment were sold at 500. So what is the initial cost of the equipment? So for the solution of that problem, you need to include the purchase price or the cash price equivalent, which is 100,000. Then you will add the commission to brokers, which is 5,000, import duties 25,000, and also the non-refundable purchase taxes, which is 10,000. The other expenses is transportation costs 1,000, assembling and installation costs 2,000, and also the testing costs is 1,500. So you need to less this one, the net proceeds from samples, which is 500. So the initial cost of the equipment is 144,000. As we can see in this example, we clearly identify that the proceeds from samples generated are deducted from the initial cost of the equipment prior to the amendment of IAS 16. And now let me show you the new solution for the new amendment. The purchase price, which is 100,000, commissions to brokers 5,000, import duties 25,000, non-refundable purchase taxes 10,000, the transportation cost, which is 1,000, the assembling and installation cost 2,000, and also the testing cost of 1,500. So the initial cost of the equipment is 144,500. In this solution, under the new amendment, proceeds are no longer deducted, as we can see in the solution. As we can see in the computation, under the amendments, the proceeds from sale of commodities before accompanying property, plant, and equipment is ready for its intended use are no longer subtracted from the cost of PPE. Instead, the proceeds as well as the expenditures of creating those items are included in profit or loss.
As mentioned earlier, the initial measurement of an item of property, plant, and equipment includes direct cost of bringing the asset to the location and condition necessary for it to be used in the manner intended by the management. Before we proceed to a discussion on the measurement of items produced, let us first discuss the following relevant terms. First, testing cost. Before an item of PPE becomes ready for use, an entity conducts testing or trial runs to ensure that the item is functioning properly as intended. And of course, these activities incur costs, which are included when computing for the initial cost of an item of property, plant, and equipment. Prior to the amendment, costs of testing are added after deducting the net proceeds from selling any items produced. However, under the new amendment, the cost of testing is added without deducting the said proceeds. Next are the items produced during testing. These refer to items produced before an item of property, plant, and equipment becomes available for its intended use, including samples generated during testing or when conducting trial runs. Under the new amendment, an entity recognizes the proceeds from selling any such items and the cost of those items in profit or loss in accordance with applicable standards. Let's now proceed to our discussion on measuring the cost of items produced. Under the new amendment, proceeds from selling items before the related item of property, plant, and equipment is available for use should be recognized in profit or loss together with the costs associated with that item of property, plant, and equipment, in accordance with IFRS 15, Revenue from Contracts with Customers, and IAS 2, Inventories, respectively. When the board first exposed the draft amendments, they did not propose any requirements on measuring the cost of items produced before an item of property, plant, and equipment is available for use. However, many suggested that the board develop such requirements, saying that the cost of items produced could require extensive judgment, which in turn could result in differences in how entities measure that cost. That is why, upon consideration of this feedback, the board decided to require an entity to apply IAS2 inventories in measuring the cost of items produced. The board made this decision because, firstly, IAS2 sets out a framework for measuring costs without being overly prescriptive. And second, an entity would already be required to apply IAS2 in measuring costs if the entity were to determine that the sale of items produced is an output of its ordinary activities. In that case, the items produced would meet IAS2's definition of inventories. Hence, it would be useful to apply the same requirements to the cost of items produced, irrespective of whether the sale of those items is an output of an entity's ordinary activities. Furthermore, the board concluded that the judgment required in determining the cost of products produced is not significantly different from judgment already required when applying IAS2 and other IFRS standards in measuring cost. In particular, for assets that takes a substantial period of time to get ready for their intended use. For example, measuring the cost of abnormal amounts of wasted materials and labors, allocating cost to joint products, or measuring the cost of operations incidental to construction or development of an item of property, plant, or equipment. Let us now proceed to our illustration. Himawari Corporation constructs equipment for its own use. The following are the costs incurred in relation to the new equipment assembled in 2022. Raw materials used in construction for new machinery, 228,000. Labor in construction of new machinery, 147,000. Cost of installation, 33,600. Cost of testing the equipment, 25,000. Factory overhead directly attributable to the new machinery, 50,700. Sale of sample items produced during testing, 10,000. Cost of raw materials used in sample items produced, 5,000. The requirement is to compute for the initial measurement of the cost of machinery. For comparison, solutions are presented for both the previous and new treatment. Prior to the amendment, the cost of machinery includes raw materials used, 228,000. Labor, 147,000. Factory overhead, 50,700. Installation, 33,600. Cost of testing, 25,000. Less the net proceeds from sale of sample items, 5,000. Resulting to a total cost of 479,300 capitalizable cost. On the other hand, the cost of machinery under the new amendment include raw materials used, 228,000. Labor, 147,000. Factory overhead, 50,700. Installation, 33,600. And cost of testing of 25,000, resulting to a total cost of 484,300. And recognized in profit or loss in accordance with IAS2 are proceeds from sale of samples, 10,000. And cost of raw materials used, 5,000. Continuing on our analysis. First, the amount of cost capitalized is higher under the amendment. Prior to the amendment, net proceeds are deducted from the cost of testing, reducing the amount of cost capitalized as an item of property, plant, and equipment, which in this case, the machinery. Second, net proceeds from the sale of samples were not offset against the cost of testing. Thus, as you can see in the illustration, the total amount of cost capitalized is higher under the new amendment, as this does not offset the amount of net proceeds in the computation of the cost of PPE. And lastly, the amount generated from the sale of samples and the related cost of raw materials used are now recognized in profit or loss. As discussed earlier, in applying this amendment, companies will need to distinguish between costs specifically related to producing and selling items before the related PPE is available for use, and other costs generally related to making the PPE available for its intended use. Hence, the amount generated from the sale of samples and the related cost of raw materials used are now recognized in profit or loss, while the cost of testing would still be included in the measurement of the cost of machinery. Let's proceed. Testing the functioning of PPE. The new amendment also provides clarification on the meaning of testing of functioning of property, plant, and equipment. According to IAS 16, an entity is required to determine when an item of property, plant, and equipment is available for use. However, there have been differences on how entities determine when an item of PPE is ready for its intended use, resulting to many users suggesting to clarify this issue. But the board decided not to, since it would be broad in scope and it might affect the measurement of many items of property, plant, and equipment. And additional research would be required to assess potential unintended consequences. Furthermore, the board had obtained no evidence that differences in how entities determine when an asset is available for use would lead to material differences in the entity's financial statements. In response to this issue, the board decided to instead clarify the meaning of testing in paragraph 17, noting that such a clarification might help an entity in determining when an asset is available for use. Accordingly, the board concluded that when testing whether an asset is functioning properly, an entity assesses the technical and physical performance of the asset. Also, the assessment of functioning properly is not an assessment of the financial performance of an asset, such as assessing whether the asset has achieved the level of operating margin initially anticipated by management. The revisions to the standard also clarify that testing means assessing whether the technical and physical performance of the asset is such that it is capable of being used in the production or supply of goods or services, for rental to others, or for administrative purposes.
Now, we're gonna talk about the new disclosures added in the standard. There are two of them. We're gonna start off on sales of items that are an output of a company's ordinary activities. For this type of sale, the disclosure requirements of IFRS 15, revenue from contracts with customers, and IAS 2, inventories shall apply. This requirement is basically just a clarification from the board that there are already standards in place for such type of sale. Now, for the second disclosure, it is for the sale of items that are not an output of a company's ordinary activities. In this case, companies are required to disclose the following if not presented separately in the SEI. First is the amounts of proceeds and costs included in profit or loss. Pretty much, it goes this way. You didn't present them separately in the SEI. Now, you need to disclose them separately in the notes. You also need to identify which line item or items in the SEI includes such proceeds and cost. Here is the actual amendment made to the disclosure section of the standard. Note that deleted text is struck through and new text is underlined. As you can see here, paragraph 74D of the standard have been deleted, but it is not amended. They only moved it to paragraph 74AA. Meanwhile, the board developed the requirements in paragraph 74AB to provide users of financial statements with information about the sale of items that are not an output of a company's ordinary activities. Because users of financial statements said, information that enables them to identify proceeds before intended use and to understand how those proceeds and related costs affect an entity's performance would be useful. Regarding the sales of items that are an output of a company's ordinary activities, the board decided not to develop similar requirements done in paragraph 74AB because, just like I said earlier, there are already existing standards for that. Now, let's talk about the transitional provisions. An entity shall apply these amendments retrospectively, but only to items of PPE that are brought to the location and condition necessary for them to be capable of operating in the manner intended by management, on or after the beginning of the earliest period presented in the FS, in which the entity first applies the amendments. If we remember, when we account retrospectively, previous financial statements are restated as if the change had always been applied. Also, an entity shall recognize the cumulative effect of initially applying the amendments as an adjustment to the opening balance of retained earnings or other components of equity as appropriate. at the beginning of that earliest period presented. Here is the actual paragraph added. Paragraph 80D for the transitional provisions. To further understand the amendments made for the disclosure of and transitional provisions, here is an actual illustration. The entity's annual reporting period ends on the 31st of December. It presents only one comparative period. As of December 31, 2020, there were items of PPE under construction whose cost was reduced with 1,000 pesos of proceeds obtained from selling sample products. Cost of the sample products are negligible as such not included in the example. Additionally, during 2021, further proceeds of 500 pesos were credited to PPE, and the item was activated in January 2022. Applying the IAS 16 amendments, the following adjustments are to be made in the financial statements for 2022. First, the entity shall recognize 1,000 pesos as an addition to both the PPE and retained earnings on January 1, 2021. Why do you need to add 1,000? Because before the amendments, entities are required to deduct the sales proceeds from selling sample products to the cost of the PPE, just like in the example of Ms. Hazel earlier. Therefore, you need to revert it back as if the entity had always been applying it. Upon reversion, you need to debit PPE under construction because it is only on January 22 when the PPE was activated. When we say activated, it is operating as intended by management, which is also a requirement in the transitional provisions. Now, on the credit side, retained earnings should be credited because the proceeds will now be part of your income, not as deduction to the cost of PPE. The reason behind the second entry is almost the same as the first one, except for the credit side. This entry is actually an example of the new disclosure I discussed earlier. With this kind of credit entry, you can present the proceeds and its related costs separately in the statement of comprehensive income. So, you need to disclose them in the notes. The effective date of the amendment is January 1 this year, but earlier application is permitted. If an entity applies those amendments for an earlier period, it shall disclose that fact. The takeaway. The practical challenges of implementing the amendments can be complex. A big change for some sectors, especially the energy and petrochemical sectors, will be the cost allocation process. Making the allocation of costs can be a difficult process, which requires significant estimation and judgment. Entities should start planning for this challenge now. They need to understand how their systems currently look like and how they can monitor these costs at a more granular level to allocate costs, and make sure they have clarity on exactly which data is needed. This can only come from a deep understanding of the relevant accounting standards.